In this video, we're going to cover covered call ETFs. Covered call ETFs have become extremely popular recently because of the very high income yields they offer. So before we get started, this video is for educational purposes only and should be not considered financial advice. Always do your own research before making investment decisions. So in this video, I want to break down how covered call ETFs actually work, why the yields appear so high, and the trade-offs investors should understand before investing in them. So why covered call ETFs are so popular? Well, the biggest reason why covered call ETFs have become so popular is actually pretty simple. It's income. Many of these funds advertise very high yields, sometimes 10, 20, even higher percentages. In fact, I personally was invested in one that was north of 140%. So for investors looking for constant income, especially retirees, that could look really, really attractive. But to really understand whether these funds make sense in your portfolio, we first need to understand what is behind the strategy in them. So what is a covered call? A covered call is an option strategy where an investor owns a stock or ETF and then sells the call option against that position. So by selling the call option, the investor collects option premium from the option buyer, and that becomes the option seller's income. So the trade-off is that if the stock rises above the strike price of that call option, the upside potential becomes limited because the shares could be called away. So the strategy essentially trade some upside potential in exchange for income. That's basically what a covered call is. So how do they actually use a covered call strategy inside the ETF? Well, covered call ETFs, they use the exact same strategy that I just told you about in the covered calls, except they do it at a fund level, which is to say the ETF holds a portfolio of stocks or tracks an index, and then it sells call options against those holdings. The options premiums collected from those call options are then distributed to investors as income. So they sell these covered calls, they collect option premium, and they distribute it to investors like us. So instead of managing these option strategies yourself, which can be pretty daunting, it's if you don't know much about covered calls or even options in general, it can be kind of scary. So having somebody like an ETF handle that process for you could be nice. So that's what these ETFs do. So why covered call ETF yields why are they so high basically? So options premium generate income. One of the covered calls that often shows high yields is because of the premiums that these options collect. So when a fund sells the call option, it collects premium from the option buyer, as I said a little bit earlier, and those premiums can then be distributed to the investors. During those periods of higher market volatility, options premiums can increase, and then that actually leads to higher income distributions. So a lot of these ETFs are going to be playing covered call strategies on high volatility stocks and high volatility ETFs. So one of the things that investors need to understand that part of the distribution that you get are considered return of capital, and that can affect how the yield appears. So return of capital isn't all scary, and it's not just the return of their money that's in there. Technically, through the IRS and the strategies that um, are considered a taxable event, return of capital is not a taxable event. So you get your return of capital. You don't have to pay tax on that capital that was returned to you if it was return of capital. The caveat to that is very simple. When you collect those return of capitals, it lowers your cost basis on the ETFs that you actually hold. And if you ever sell those ETFs, the difference between the price that they are currently and the cost basis that you have in those ETFs will be a taxable event. So some of the strategies that you could deploy is, well, don't sell them ever. And you collect income until you can't, and just don't sell them, and then you won't have a taxable event. So the trade-offs investors need to understand: upside is potentially capped. So the key trade-off with a covered call strategy is the upside can be limited. Because the fund is selling call options, strong market gains may be partially capped. So if you are in a strong bull market, covered calls can oftentimes underperform the broader market. So a lot in if you were a person that was playing these covered call strategies and you were in a strong bull market, it would not be completely advised to sell covered calls when you think the stock is going to go way up. These strategies are best done on stocks that are moving sideways or slowly moving up. You don't want strong, fast movements up. That gets you a little bit behind the eight ball, as far as it's better just to own the shares of the stock as opposed to an ETF that sells covered calls. So um, while the income may look attractive, investors should always consider total return, not just the yield. And total return is the yield that you get from your covered calls strategies, or the income that you get, and plus or minus the stock appreciation or depreciation. That gives you a total yield. So anytime you're looking at these, always look at the total yield. That gives you what it really is. Don't look at just the yield that it produces, and don't look at just the fact that maybe over time they lose value over time. You add the two up to get your total return. If your total return is north of 30% on one of these ETFs, that's pretty good. That might be something that you want to invest in. So that's something to consider when you're in these. So who are these covered calls appropriate for? Well, covered call ETFs can be appropriate for investors who are primarily focused on generating income. Okay, so they can sometimes fit well in retirement income strategies where consistent cash flow is more important than maximizing growth. So in your retirement years, cash flow is much more attractive than growth. You're looking to spend your money in retirement, not try to build up your portfolio, or at least a lot of people can't. So, however, for investors that are focused on like long-term capital appreciation or growth strategies, these may not be the best fit for you. But like any investment strategy, it really depends on your goals and your needs as an investor. So my final thoughts: covered call ETFs can and do generate nice yields and income, but you got to understand the trade-offs that they come with. And always focus on the total return when investing, basically any instrument. That's the best way to determine if the strategy is right for you or not. Thank you very much for watching this video. I hope you enjoyed it. I hope it gave you a little clarity, And if you could like and subscribe, I would love it. And thanks again for listening.